Hi, everyone. This is Alex, and I'd like to welcome you to Retire with Style with Wade Pfau. How's that,
Hey,
Wade?
Alex. Hey, everyone.
And today we're going to be talking about, again, long-term care insurance, traditional and hybrid policies. So it's a barn burner, right, Wade?
That's right. We did make sure we're better prepared than we may have been with the Medicaid last week. But
Why?
so,
Why are you saying that?
well, Medicaid just so complicated with the different states. It's hard to really know what to say. But we've got some clear things
Wait,
to say today.
Wait, there's an old rule in the entertainment industry. Let me bring you in on no, I don't. It never, ever, ever let the audience know how unprepared you are. So
Well, we're
we
not
won't.
unprepared today. We were
So we,
just unprepared in the
so
past.
why are you bringing me into this? The we? What part of we? What part of we are you referring to? The are
Elite.
you are you referring to the royal we when you say that?
That's right.
Wait, I get if you don't know, the last week's episode and this week's we're recording them literally back to back. Like, we just took
Well, we
a
had to
coffee break.
pause to make sure we were ready for this one.
Yeah, we
But
had to
otherwise,
set
back
it.
to back.
No, again, we don't bring me down again. Don't, no, I do not subscribe to your statement. But that being the case, I even put on a fresh shirt. I put
Yes,
on a
you
fresh. Yes, I did.
You change clothes to maintain the illusion of live.
Yes, the grand illusion, or just the normal illusion.
Yeah, this one's an illusion, not an allusion.
Okay, no, it's because of YouTube. How we're on YouTube, and check us out on YouTube.
Yeah, you'll
Smash
see me
that
wearing
like
the.
button, everybody.
You can just say I wear the same clothes every day, so
Well,
it
there was
doesn't.
one episode. I think there was one day we did like three in a row, and then I noticed on YouTube it's like, man, I've got the same shirt, like back to back to back, triple shot Thursday. Get the let out, kind of thing. So yeah, I changed. I was telling my wife I went in between shows. I was like, I gotta change. I've got another podcast to do. Where are my
Wardrobe,
clothes? Yeah, exactly, kind of. I'm explaining.
wardrobe
That's
makeup.
why I gotta buy shirts, Christy. I need more shirts. All
I
right,
know you
so
can never. We have more than 100 episodes now. You should have at least 100 different clothing items.
well, I can't. I'm a man of the people. I'm a man of the people, way. So if I have that many shirts, it's not on brand for me. You know what I mean?
Well, I just
I'm
wear the
the
same
I'm,
thing every
I'm the
time.
everyday. I represent the everyday man on this podcast,
You're the
not
people's
the.
champion.
Thank you, the people's champion. I think was it Hunter? Hunter Pistol? I think he sort of said that kiddingly. First, I don't know,
Oh.
some silly thing I said. He was like, "Oh yeah, the people's champion, of course." I don't know. I think he meant that ironically. I'm more of a misanthrope, in real life, but that's
The
fine.
champ is here.
Yeah, the champ is here. Ding ding, ring the bell. All right. So traditional long-term care. Fire away, Wade, and I'll fill in the gaps, especially the areas that you get wrong. I'll make
Yeah,
sure
yeah.
to
This is
to
where
pop in. I'll make sure to pop in.
you didn't have to worry about preparing. You just have me monologue.
Oh
But
my God, what is this? What is this? What is this?
well, do you have
I'm
any
doing
questions for me about long-term care insurance?
I'm doing my best here, Wade. I'm doing my best. I'm just one man here. Wait, now go
So,
ahead.
yeah. In this episode, we'll talk about traditional long-term care insurance first, then hybrid policies. Yeah, but really, to be clear, the direction or the momentum is really shifting towards the hybrid policies. The statistic is that less than 6% of Americans age 50 and older, and even less for younger ages, have traditional long-term care insurance policies.
So are you
These
saying what we're going to talk about for the next 15 or so minutes
is
is
not
less
really
and
relevant.
less? It's not really relevant.
Yes.
Okay, so please listen to this at three times, not the normal one and a half times. Wade's voice will be even higher pitched.
No, but it's still relevant. You may have, especially sometimes with employers, one of the benefits is it probably not paid for you, but you may have access to a group long-term care insurance plan, something to look at. But yeah, at the end of the day, we'll talk about the reasons why, but traditional long-term care insurance is becoming less popular. Uh, Hybrid policies, life insurance, primarily life insurance with long-term care, is becoming more popular. But to understand why it's becoming more popular, we have to understand why traditional policies are becoming less popular. So there's
Okay.
there's the hook.
Thank you, thank you. You brought it back. You brought it back.
Yes.
Hey, one of the things that as I was looking through this and we were discussing, we thought a good question here would be the calisthenics of how the payments work, such as, you're paying premiums, when you stop paying premiums, or what happens when you get, when you need to access long-term care. And then what happens, let's say if you do get out of it and you're fine 2 years later, a year later, some certain time period, you've recovered. You went to Lourdes and you poured holy water or something like that, and you've recovered. Now what happens after? Do you do you continue to pay premiums again? How does that work, Wade?
Yeah, so we can never speak in absolutes. It's important to make sure you read the specific details of the policy. But generally speaking, whenever you qualify for long-term care benefits, premiums would stop. Now you're talking about this scenario where then you recover, no longer need the benefits. Probably, but there could be exceptions. You can go back on policies, start paying the premiums again. You would not have the whole benefit pool available, but whatever was left in terms of available benefits, you could then subsequently have access to for a second potential long-term care event in the future.
But okay, but one thing that I want to make sure they didn't miss that you said is you're paying premiums. Could you pay premiums for like a year? And then all of a sudden, bam, you need to access it. You stop paying premiums and you just receive benefits.
Mm-hmm. Yeah, just like with life insurance, the sooner you need benefits, the higher the internal rate of return on your premiums, because you didn't have to pay premiums for as long. Not that you want that to happen, but yes.
Are you suggesting they drive without a seatbelt as soon as they pay for long-term care insurance?
That would be the moral hazard, but
Oh,
right.
wow, wait, look at that.
Now that's a term for if you're insured, you start behaving in more risky ways because you'll have those benefits available. The risk there is that you need the life insurance rather than the long-term care insurance.
You sound like the Fed. That's what when they always go into monetary policy. That's
oh yeah, that term.
Bingo card words, moral hazard.
Yeah,
right.
Federal deposit insurance. You no longer worry about your bank deposits. Same idea.
Yeah. Okay. And then there's some policies. Obviously, results vary. Read the directions, but if you do recover, there's some policies that you just resume business as usual, like before.
Yeah.
Correct.
Yeah. Although this is a more minor detail, but yes, generally speaking.
I was always curious.
Yeah, it's a great question.
Oh, thank you. Thank you. It's the quality of the questions that's important in life.
And these are not ChatGPT generated.
And then another piece that was interesting, and we spoke about it in a previous episode, and you thought this is a good point to bring out. What when you get these policies, there's talk about a care coordinator, and that's not necessarily a throwaway line in the policy. That's actually quite important. Can you delve into that?
Mm-hmm. Yeah, so when you get to the stage in life where you need help and you need to find either in-home care or a facility, assisted living, nursing home, that can be a very stressful time. And so a care coordinator is a professional who knows the options in your community and who can help you find the right care. You could pay for that. Just if you're self-funding for long-term care, you could find a care coordinator and pay for that service. But many long-term care insurance policies do include a care coordinator as part of the package. So if your policy has a care coordinator, it's definitely something you'll want to take advantage of and can be very helpful to get you situated and get you the care that you need.
Okay. And then I'd like to play off this other thing that you said. I don't know how you knew this by memory because I know you're not reading from the slides. And if you don't believe me, look at the YouTube. Track his eyes. Track his eyes.
Darting over to the left.
What was that phrase? There's a quote in Scarface. It's in the eyes, Manolo. Or I gotta look it up. It's in the eyes, Chico. You can see.
I've not watched Scarface yet. It'll be on my list at some point.
I think Oliver. I want to say Oliver Stone wrote that of all people, and it's a Brian De Palma film. He's good. Brian De Palma's done a lot of good stuff. The Untouchables, things like that. He's good, but it's more less than 6% of the population age 50 or older have a long-term care policy. Now,
you already
I'm
said
setting
that.
No. Pay attention. I'm going somewhere with this.
Okay.
I'm throwing you a softball down the middle come on, man. What? Now, I don't want people to read that, hear that from you and think, oh, they're underserved or not. There's a certain subsection of people that it may not actually be a financially relevant thing to do. You see where I'm going with this now, Wade?
There you go. Yeah, that's a good
Okay,
transition.
a little bit of patience, Wade, is all I'm asking. A little bit of patience. No, no, no. Why is that,
Brilliant.
Wade? Yes, thank you, thank you.
Well, yeah, that gets into, so you may either be, you don't have enough wealth to really need to worry about long-term care insurance, or arguably you may have too much wealth where you can just self-fund and not need long-term care. Though I think I think we've talked about in past episodes, if you have too much wealth, you might still benefit from having long-term care insurance because you feel more comfortable spending the insurance company's money. You're protecting the inheritance for your children and so forth. You may have that care coordinator benefit. But the other direction here, sometimes you just may not have enough wealth to really need to worry about having long-term care insurance. You may not be able to afford the premiums because it can be expensive. There may be an issue, and this is kind of a tragedy of when we talk about why there's been this switch to hybrid policies. With traditional long-term care insurance, the Boston College Center of Retirement Research had a really interesting study about how people tend to lapse on the policies just before they need them, either because the policies became unaffordable or because as people are dealing with cognitive decline, they forget to pay the premiums. There's ongoing premiums with traditional
This is,
long-term care insurance.
I thought,
Uh,
I correct me if I'm wrong. I thought it was brought up last time. I don't know if it was with Rob or yourself. Somebody said this. Again, I don't quite remember. But one of the reasons these policies were unsustainable by the insurance companies is because the underwriting was done, what, obviously I say this with hindsight, was incorrect.
mhm.
And one of the reasons it was incorrect because the people that bought long-term care actually held on to it, like actually paid the premiums,
Right.
beyond what they expected in terms of lapsation. Now I think you're saying people lapse on it. More people lapse on it.
You remember well. Yes. The
Thank
well,
you, Wade. Again,
unfortunately,
thank you.
the people, some,
Thank you, Wade.
not everyone lapses, but unfortunately, there's been many cases where people are lapsing just before they could have qualified for benefits. But overall, yeah, insurance companies were expecting much higher lapse rates than what actually happened. Plus, people were living longer than they anticipated, and so were on claim for longer than anticipated. Plus, with interest rates having gotten so low, that really wasn't part of the actuaries' calculations. So they were really just underpricing the premiums for the long-term care insurance. And that's led to many companies dropping out of it. That's why there's a shift away from traditional long-term care insurance. Many companies have dropped out of the market. Those that have stayed in the market have had to have significant premium hikes on existing policies. And also, they've really had to cut back on the benefits. There's no longer lifetime benefit provisions and so forth. And that's just been a part of needing to collect enough premiums to pay for the promised benefits so that they coordinate with the state insurance commissions. We've got to raise premiums or else we can't afford to pay the benefits. And so
Okay.
those premium hikes have caused some people to lapse, though I guess really just not as many as the initial projections were expecting.
Okay. So then for people listening in, to me, the takeaway, there's two takeaways. Obviously, there's a low take-up rate, right? What was that number? Less than 50% or what, next to 6% of the people age 50 have it. But if first world problems, if you have a high enough asset base, and you're thinking of self-insuring, fine, not an issue. And I think you're heading down that path, and I may be heading down that path, although hybrid seems to be in my future, and we can get to that later. But it's the other side that I'm concerned with is the folks that are on the lower end of that percentile, and they're thinking, oh, you know what? I need to fill out my financial planning checklist, check boxes, and long-term care policy is something that I need because that's what I need. That may not be actually the wisest financial move, from that standpoint, because the premiums will go up and up, and then what can you really afford as opposed to drawing it down and going into Medicaid? Way.
Well, yeah, and the Medicaid is the other important point there, that if you don't have a lot of assets to begin with, it may not really be necessary to have long-term care insurance because you'll qualify for Medicaid. Now, you may want a small policy so you can make that transition before entering Medicaid. But at the end of the day, if you don't have the assets, you may be in some way wasting money on long-term care insurance premiums when you could have just qualified for Medicaid anyway.
And
now, there are some, we won't get into detail, but there are some state partnership type programs that have long-term care insurance where what you put into those policies will create protected assets that you can keep and still qualify for Medicaid after the benefits end.
But I want to make sure people understand what you say, like buying a policy just for a little bit and then transitioning into Medicaid. Wade is referring to the fact that you can use long-term care to get into a program, and then once you're in that program, you can get on Medicaid, and it's kind of a little tougher to gap down in service from that area, that as opposed to if you go in with Medicaid, you may not get their quote unquote expected level of service that you would if you didn't start with Medicaid. Now that's just more anecdotal, but that's what you're getting at when you say that, right?
Yeah, it is an anecdotal point, but yes, everything else being the same, there may be many cases where you have a little bit easier time getting situated with care if you're not yet on Medicaid when you first enter the care.
All right. And now, since you talk about premiums, what are you looking at in terms of increased premiums, et cetera? Because you were saying it may not be worth paying the premiums, but imagine if you don't have enough money, you start paying the premiums, and those premiums go up unexpectedly, or expectedly go up unexpectedly.
Known unknown. Yeah. So in the future, hopefully the insurance companies have got things figured out better. They're assuming people are going to stay on policy. They've gotten used to the lower interest rate world, and so it can incorporate lower interest rates into their long-term projections and so forth. So hopefully we won't see as big of premium hikes in the future as we've seen in the past. That being said, though, a rule of thumb that I've seen repeated a number of times is just plan with traditional long-term care insurance a potential 50% premium hike during the life of the policy before you are on claim, just as a further precaution that make sure it's affordable, that you could handle a 50% premium increase and it would still be affordable, is a good rule of thumb. Hopefully it's not going to come to that, because hopefully pricing is better now, but it is something.
And I kind of jumped the gun a little bit with some other items. So just to bring it back a hair before you get into the premiums, what age should people start looking into this?
Well, the general rule of thumb on that is by the time you're in your 50s. Now, it's not a universal thing that you just wait till your 50s. The younger, the better. But often at younger ages, people have competing priorities. Long-term care is not yet on the radar. Waiting until your 60s, though, can be risky, both because if you develop health conditions, you may be disqualified from having care. There's an extensive underwriting process for long-term care insurance. And if you develop any health issues that might make it more likely you'll need care, you may not qualify for the insurance at that time. The other issue, though, and when we were talking about this in advance, is like the reverse of Social Security delay. If you wait to start long-term care, you don't have to pay premiums while you're waiting. However, when you start paying premiums, the increase in the premiums starting from a later age kind of offset what you missed out on paying in advance. So you don't really come out ahead by delaying. So it's not like, I'm going to wait until my 60s because I don't have to pay premiums in my 50s. No, if I start in my 60s, premiums are going to be much higher. And it's not going to be long before you break even on the idea of, I wish I would have started earlier so I could have been leveled into the program at a lower premium. So that's all leading to 50s as the rule of thumb around.
Yeah. So from a financial planning perspective, you're doing your plan, this and that. Look, whenever you can, if you're going down the route of long-term care, I get the sense the answer is whenever you can budget for it, you do it. As like, you don't need to be in your 20s, obviously, but when you're at that age where you're thinking about it, if you can afford it, start doing it, because there's not really a monetary benefit from waiting, because the rate of increase as you get older will be faster, and it'll more than like cross over into you just got in it sooner.
And this came up in our episodes with Jackie Smirka and with Rob Cordeau, that yes, as you get older, the probability of needing long-term care increases, but it's not zero at younger ages. And so there are people who need long-term care when they're in their 30s or 40s or 50s. So if you already have coverage at that point, you can qualify for benefits at that point as well.
Okay. Then what are the overall characteristics of traditional, not hybrid? So we want to then compare later. So since it's fresh and so it's so for it to be fresh on people's
Uh-huh.
head,
Oh, well, for
what are
this,
some?
a
Go on.
lot
Sorry.
of these characteristics we'll talk about here are similar for any either the hybrid or traditional policies. It's more about what's covered with long-term care insurance. So,
Okay, let me ask it another way. What's covered in long-term care insurance?
yes, so usually it's going to be skilled nursing care, intermediate care that may require some more medical knowledge but not purely skilled, or custodial care, which is the unskilled, considered unskilled care with help for activities of daily living. So that's bathing, dressing, feeding, that sort of thing is custodial care. But you should look for policies that will cover skilled care, intermediate care, custodial care. Usually policies will kick in with benefits if you need help with at least 2 of the 6 activities of daily living that we identified in I think the very first episode we did on long-term care. And then
Ages
also,
ago. Ages
yes,
ago.
ages ago at this point. And cognitive decline. You'll want to make sure the policy can also trigger benefits in the event of cognitive decline, because sometimes cognitive decline, you might still not technically need help with activities of daily living, but you really do need help. And so does it have provisions for starting benefits in the event that a doctor or professional has determined that this individual qualifies for benefits?
There's also this point about the cognitive decline. It also, to me, the moment you said that, I thought of the importance of the caregiver, the caretaker coordinator, the
Mm-hmm.
long-term care coordinator, because one of the issues is dementia, and so you want people
Yes,
on your team.
because so it's either the care coordinator or it's your friends or family who are needing to figure this all out. In many cases, when we talk about all these things you need to do, when you're at the point where you need care, you may not really be able to make these decisions. So it's not so much you necessarily, but whoever in your sphere of orbit who's helping you out with this, they need to be figuring these things out. Where to
So
live, what kind of care is needed.
wait, I'm a bit older than you, so you're gonna cover for me?
Yes, I'll have to get your power of attorneys.
Hey, this is recorded. No, all right, all right.
Access all your accounts.
It goes the day trading.
Yeah, take it to the horse tracks, right?
Yeah, Keeneland. All right.
But then what does the policy cover in terms of what will it pay for? You want to make sure a broad range of care is covered: nursing home care, assisted living, at-home care. Some policies may not pay for in-home care, so you want to make sure that's offered. Potentially also, now every policy is different, but looking at what it provides, are the care like coverage for homemaker services, hospice care, potentially the adult daycare centers. Will the benefits pay for time spent at an adult daycare center? International coverage, respite care, which is if you have an unpaid or informal caregiver, your family member, friends, uh, having someone temporarily help out so that that individual gets a break. That's what respite care is. Will the benefits pay for respite care? Bed reservation. Will it hold your spot at, say, an assisted living facility or a nursing home if you are away at a hospital? Does it have the care coordinator benefit? Is caregiver training? So if you have informal caregivers, will it pay to provide training to those individuals? And also any sort of supportive medical equipment. Will that be covered as part of the policy?
I like that in here. One of the things you're saying, and it's kind of a relatively new term, is respite care. I can't stress enough how important that is if it's available. And I'm not doing it from the long-term care standpoint, but I'll talk about my sister. My sister I have a niece who has significant developmental disabilities that needs effectively like a 24/7 supervision from my sister and brother-in-law, et cetera, and family. And there's burnout. I mean, she loves her dearly, that kind of thing, and she's great and everything, but it is a full-time job. And luckily they have the resources, but even having the resources isn't enough. Every once in a while, you need to hit the pause button for your own mental sanity.
Mm-hmm.
And I see that in my sister. So respite care, 100%. That's something that becomes available just because I've seen it personally. It's worth it. Simply because no matter how much you love somebody, every once in a while, you just need time for yourself to just take a breath.
Yeah, absolutely. And adult daycare centers can be more of a formal way to get respite care, but it may just be you need a day a week where someone comes to the home to help out, giving you a break. That's another type of respite care. And will the insurance pay for that? It's kind of the question here.
Okay. And then, well, I want to make sure any other characteristics you want to chime in on?
No, that was
Okay.
the
Then
point.
you're talking about pay for. I think something that we were discussing before the podcast, that it's a semantic thing, and these are one of these times where in this industry not everything conforms to the English language the way we know it. And so I just do that regularly myself. But you want to talk about level premiums and what that means?
Yeah. So a lot of these traditional long-term care insurance policies will have what's called level premiums. Now, in normal everyday to day English, that probably makes you think the premiums are level, they won't go up. That's not what it means in the long-term care world, which is the whole issue of premium hikes. What level premiums means is just because you get older or just because your health status changes, that won't uniquely trigger a premium increase. It doesn't mean that premiums can't increase. It does mean that if the insurance company petitions to the state insurance commissioner that they need to raise premiums to be able to pay for the promised benefits, level premiums just means that those premium increases will be applied across the board to all the policyholders who purchase policies at a particular time and so forth. So it's your premium hikes will be done in a level manner across everyone, not your premiums stay at a level.
So the good news is we're not just raising your premium, we're raising everyone's premium.
Everyone's premiums are going up.
All right, so since we've been talking about movies, what was that quote that Joe Pesci had in Lethal?
You're gonna have to wait a couple more years before I have every movie down.
No, in Lethal Weapon 3.
I think
I
the
still
only Joe
remember that.
Pesci movie I've seen is Home Alone.
You didn't see Goodfellas?
Not yet. It's gonna have
You
to be on my
haven't
list.
seen Goodfellas? You really have never seen Goodfellas?
No.
Wow. Wait.
Is that
I
the
don't
one
know
where
if
he
you.
says like, "Do I look like a clown to you?"
Yeah. Am I funny? How am I funny? Yeah. No,
Yeah.
Goodfellas is like, wow, really? All right. No. Well, this is more. This is not that movie.
Is
That's
that worse than Bob not seeing Godfather?
it's up there. Honestly, Goodfellas. You can make the case. It's as strong of a movie as The Godfather 2, but well, we're getting off topic here. This is for another. This is like a whole podcast in and of itself that you haven't seen Goodfellas, but
Give me a couple of
I,
years to catch up on your
a couple of
filmmaker.
years. But what was I going to say here? No, it's Lethal Weapon 3. Remember, he goes to the drive-through and they screw you at the drive-through, and he didn't say they screw you at the drive-through. This is what level premiums is, right? Like they kind of screw everyone at the same time. So
Yeah.
that's my connection. There it is. Adding
That's
value, Wade.
a great allusion to the classic film.
Is it an analogy, illusion, metaphor? What is it?
It's an illusion, right?
Yeah, I'm just messing with you. All right. All right, so that's the traditional policies, right? And so not to lose the point, level premiums when they won't specifically just target you, they'll target everyone within your cohort and raise it. And they have the right to do that. Okay?
They
So
have to convince the state insurance commission, but
yeah, but I'm sure there's some
if the
lobbying
option
money
is
behind
going
that.
bankrupt and no one getting anything, the
Yeah,
state insurance commission.
and this goes back to the previous point you made where you just naturally assume there's going to be a 50% increase in premiums over the course of the policy.
Yeah, that's still have a conservative assumption if you're getting a policy today that bake in, can I still pay the premium if it was 50% higher? It's a good rule of thumb to keep in mind.
Okay. Now, this is for the Excel wonks out there. Do you suggest they put 50%? When do they increase it to 50%? Over the course of 10 years? Over the course of
Oh,
5 years? You know what I mean? What's the rate of that 50%? Because we're going to get
for
that
their,
question. So
you mean for their financial planning
for
projection?
that Excel tab that
What?
they're running a macro on.
I mean, the sky's the limit on what I mean, maybe just to have something 10 years later, you just increase the premium 50% for the rest of the plan. Something like that would give you a good baseline to scenario test this.
Okay, thank you, Wei. Thank you.
I mean, who knows when the premium hike will happen? It's just
Yeah, I was
there's
just
probably a lot of work to have it level up over time. Just having it happen all at once at some point in the not too distant future.
all right. And there you have it. All right, so that's the traditional long-term care policy. So why are these things not as favored right now?
Yeah, well, so it's this idea of you might lapse. So people are worried about lapsing. You've got the issue premium hikes that were unexpected that people really don't like. There is this sort of, it's true with any insurance, but this idea of use it or lose it, where long-term care insurance can be expensive. And if you end up not needing to go on claim for benefits, you put a lot of money into something that ultimately didn't provide any benefit. And so
Yeah, but I
behaviorally,
don't. But well, wait, I don't buy that 100%. Maybe it's people run out of
well,
money, or because it's a high probability event that you are going to
yeah, and
need
that's
something.
where insurance usually works best for low probability, high cost events. Because this is a high probability, high cost event, the insurance costs a lot more, and so it's like you're kind of unlucky if you don't get to use it. But it was very so this is all a behavioral type story. It's not. Uh,
Yeah, but I also think people there's a little bit of you're paying for sins of your fathers, if you will, and the people that bought it were kind of once bitten, if you will, and so vicariously people won't buy another one because they're thinking, look what they did to that previous group. So maybe this is not the right way because they still can't get their math right. I don't know.
and there are a lot fewer options. Many companies have dropped out. It's the remaining companies are fewer, and the policies are not as attractive as they were in the past. You won't find any sort of lifetime benefit. Unlike in the past, that still existed. Today, you may be really capped out at maybe 5 years max for some sort of length of benefits.
All
So
right.
it's not as attractive as it had been in the past.
But it's safe to say, regardless of how many angels fit on the head of a pin, if you will, hybrid policies are the darling.
Yeah, that's these days where most of the action is.
Okay.
And there's different ways of structuring these policies that gets partly into just where they talked about in the tax code. But you have, and so, I mean, there's annuity versions and life insurance versions, but we can cover the annuity versions with a sentence or two because interest rates tend to be low. It's hard to really tack on any life and long-term care benefits to an annuity that can still pay positive interest and afford long-term care on top of that. But there are potentially some annuity long-term care hybrids. That being said, I think at this point we'll just talk about the life insurance long-term care hybrids, which is really where more of the action is. And then that's
Okay.
where they're talked about in different parts of the tax code, but the first one is it's more, well, to kind of summarize it, it's life insurance with a long-term care overlay. The second approach is more long-term care insurance with a life insurance overlay. Now, some listeners may have a hybrid policy and not even realize it. It may be part of that first category, like I do. I have a whole life policy that I got more for the life insurance side of the conversation. And then when I started learning more about long-term care, I kind of realized reading through the policy, oh, it has this acceleration of death benefit rider, which is if you qualify for long-term care, you can start tapping into your death benefit to pay for long-term care. So it's a way to, you've got the death benefit that can be used for long-term care. Uh, and so that, I mean, in terms of my long-term care plan, thinking more along the lines of self-funding, plus I do have this life insurance policy that I could accelerate the death benefit on. My wife does not have a long-term care policy, but I think I mentioned in a past episode, I think if she ever needed long-term care, she'd probably be happier getting that in Japan than in the US. And it's a lot cheaper in Japan than the US. So self-funding is not going to be an issue for that. So that's my policy. And you, though, are currently in the process of thinking about this.
Well, I'd first like to point out something here. Wait, you've written books on the retirement guidebook, this and that, safety first and everything. Tell me that the life insurance policy happened to have this long-term care component realized after you bought the policy?
Yeah, well, I bought the policy some time ago at this point.
But it had a rider that you're like,
yes,
oh my goodness, look at this, how nice.
Yeah, it has an acceleration of death benefit rider. It's like
so
2% of the death benefit per month or something.
No, but what I'm trying to point out is, you're someone that's very astute with this kind of stuff, and it goes to show you the potential complications of these things, right? In terms of just, it's serendipitous, in your case, but and you would have taken care of business eventually. But the point that I'm trying to make is, look, these things are not as cut and dry. Read the language on everything, because then look at your situation where you had.
And it's not like the insurance company can provide that rider for free. It really just means you're tapping into the death benefit sooner, which makes the insurance more expensive. So you are paying for that. You may not realize you have it, but you're paying for it. And review if you have permanent life insurance, review whether it may be a source of potential long-term care funding.
Yeah, and as you were talking to me, this is something that, frankly, we're in the midst of this episode, not this episode, but this arc. Wade and I, we've been talking, and what I've been saying point blank, Wade, should I get the life insurance policy with the rider like you got, or should I get it the other way around, where it's the long-term care policy that potentially, if you don't use it, has an insurance component to it, right, Wade?
Yeah. So the other version, it's more long-term care, and it starts the same sort of way. Usually those policies, it's not going to be ongoing premiums. It's more either a single one-time premium up front, or maybe for 10 years you pay premiums, build up a cash value, you have a death benefit, and then you can also choose continuation of care or continuation of benefit riders, which would allow for even more access to long-term care benefits after you've used up the death benefit. And in some cases, you can even still get lifetime. It's going to be expensive, but a lifetime continuation of care benefit rider. And you can also have pooled policies for a couple where both members of that couple can tap into a pool of funds. So you've got a lot of flexibility there, but these can work more as high deductible policies, because first you just spend your cash value, then the real insurance turns on, then you start tapping into the death benefit. And then if you do have a continuation of care rider and you've already used the entire death benefit for long-term care, then you start getting those additional long-term care benefits beyond that as well. And in this case, it's not use it or lose it, because if you end up not needing long-term care or only a portion of the long-term care, the remaining death benefit is still available to your beneficiaries. And these usually have, so if you end up not needing long-term care, this is where the probability-based individual says you don't want insurance because the stock market would do so much better. Of course, not everyone just invests 100% in stocks. If you're someone who tends to hold a bunch of cash, the death benefit on these types of policies would probably be competitive with what you get on your low risk type assets. If you're, especially with a big pile of cash on the sidelines, you may be able to yield better. And there are tax benefits from the life insurance as well. The tax deferral, you're not paying taxes every year on interest. The death benefit comes out income tax free. The long-term care benefits come out up to limits, income tax free. So on an after-tax basis, for money that you'd otherwise having sitting on the sidelines in cash, this might be something to look at, where it's going to do the same as cash. If you don't need long-term care, it's going to do a lot better than cash, because you're leveraging those dollars if you do need long-term care.
Yeah, I would say there's another wrinkle here, and this is the behavioral stuff, but I'm going to go to one of those secondary factors where this provides you with true liquidity. And
Hmm.
you're kind of saying this, but I want to make sure everyone, explicitly understands here that if you don't have a policy that potentially can convert to a death benefit if you don't access it, if you don't do that, then what you're doing is you're carrying unnecessary cash and you never know. And most likely, you're going to carry more cash than what you would need to care for yourself, especially if you're also like taking a sustainable withdrawal rate from that portfolio for essential expenses and the like. Having this in place, that gives you that license to spend or gives you the ability to invest at a greater level while you're alive, which, it's a better use of assets, frankly. And so it's not just that, hey, if you didn't need it, your kids could get it and it would have been like a cash equivalent return. Well, the reality is if you have that, the amount of cash that you keep on the side will be even less. And it'll be more than, the difference will be more than just what that policy costs you, kind of thing.
Hmm.
It's just better use of assets.
Yeah, it's reducing the contingency liability. If you do have a long-term care event, you don't need as much cash on the sidelines because you'll leverage the dollars in the insurance policy. You'll get more benefits out of that insurance policy than just having a pile of cash to pay for your things, care out of pocket.
Okay. No, that was all. Like the yield is very similar to that. Okay. And what other items here, since we're pushing on the magic 40?
Yeah, we are. These what we're talking about now, which is the long-term care with the life insurance overlay, those can be called asset-based approaches. So when you see kind of the marketing from insurance companies, if they're talking about asset-based long-term care insurance, it's probably one of these hybrid type policies that they're talking about. Versus traditional long-term care insurance may be called health-based long-term care insurance. Uh, yeah, I think we have hit a lot of the highlights.
I don't think anyone's going to be saying, I want more long-term care, more cowbell, more cowbell. I think there was a bullet point we wanted to hit, which I believe was newer approaches have sought to eliminate the perceived disadvantages of traditional long-term care, such as premium hikes, finite benefit
Oh,
periods, and the like. Do you want to talk about that a little bit?
yeah, yeah. And so, yeah, I guess that's a good way to summarize the discussion. So, what hybrid policies have sought to do was reduce some of the concerns that existed about traditional long-term care insurance, and that was hybrid policies won't have premium hikes. You're guaranteed the when they use the term level premiums, they can go up, but with the hybrid policies, you're guaranteed not to have premium increases. Uh, you can still find policies that give you lifetime benefits. They're rare and expensive, but they exist. If that's a concern with traditional insurance, which may cap you at 3 to 5 years of benefits. We didn't really talk about this, but just as a general point, the underwriting is usually a bit more relaxed with the hybrid policies. They're still underwriting, but it may be more limited to a questionnaire. It's not as extensive as with traditional long-term care insurance. So in some cases, you might be able to qualify for a hybrid policy, but not for a traditional policy. You can't lapse accidentally. Now you can get your funds back, and Rob Cordeau mentioned this also. Some policies will have a return of premium option, although those can be incredibly expensive, and you may not really want that at the end of the day because it just raises the cost so much. But at
Now,
least this is a reversible decision, but you can't accidentally lapse.
now you're using the
And
word. It's just capturing my attention, and I want everyone to understand. Lapse. So you can lapse on purpose, but not like. What do you mean by lapse accidentally?
lapsing on purpose. Yeah, you can decide you don't want the policy anymore, and there may be a surrender period, but otherwise you can get your cash value back. Uh, or if you did pay for the return of premium rider, you could get your entire premium back.
That's the difference. That's all. Just Language was
Yeah.
all I wanted to convey.
Whereas
All right.
with the traditional insurance, if you forget to pay your premium, you might lapse inadvertently. Or if the premium hikes are too excessive, you might find you can't afford to continue to pay the premiums. That can't really happen with the hybrid policies. And then also, you do have that death benefit. So at least you'll get a cash like return out of it, even if you never need long term care.
And
That's
there it
long term care
is.
insurance. Yeah. Now, we will have another episode on long term care insurance because we have to talk about all the different features of benefit pools and waiting periods and is there an inflation rider and all that sort of thing. But that was a good intro into how these policies work. And we'll pick up there next time with more about the underlying features of the policies.
So this
I'm
is the
sure you're.
penultimate. This is the penultimate episode.
It is actually, yeah. Our next one should be the last episode in the long term care arc.
All right.
We're getting
Well,
close to the
true to
end.
its name, it's a long arc, but that's fine. I mean, that's what we're about here at Retire with Sal. So thank you everyone for listening in today, and we'll cap off the series next time.
All right. Have a good week, everybody.
All right, everyone. Bye.